Good day, everyone, and welcome to today's AFS Financial Solutions Executive Webcast. All participants will be in a listen-only mode throughout the call. Today's call is being recorded. At this time, I would like to turn the call over to Mr. Jay Waldron, Executive Vice President of Sales and Marketing for AFS Financial Solutions. Please go ahead, sir.
Welcome, everyone, to today's webcast. We have over 1,100 registrants for this webcast, which indicates how much executives want to hear from our distinguished speaker, Dr. Tony Sondhi, about today's topic, EITF 081 and 093, Planning for Implementation. This is another installment in our series with Tony, and we're delighted to have him back with us again today. Before we get started, let me provide a quick overview of our agenda for today. I'll spend a few minutes on AFS Financial Solutions and how we fit into today's topic, and then I'll turn the program over to Tony for the majority of our hour together. At the conclusion of Tony's prepared remarks, we've allocated time for him to answer questions submitted from our audience. To ask a question, please look at your console now and find the Ask a Question feature located at the lower left-hand corner of the webcast console. At any time during the presentation, feel free to ask a question. I'll be reading your questions during Tony's presentation and have them queued up for him when he's finished with his prepared remarks. The most commonly asked question is, can I get a copy of the slides? The answer is yes, but we make you work for about a minute. At the conclusion of the webcast, you'll get a slide that will give you a survey page URL. Go there, give us your feedback, and tell us topics that interest you. We do value your feedback. It helps us keep our executive webcast series focused on topics you want to hear about, which is why we have Tony here again with us today. You will receive a copy of today's slides, as well as a link to an on-demand recording of the presentation that you can share with others. And also, all attendees of our webcast today are eligible for 1 CPE credit. To receive your CPE certificate, you must submit the webcast feedback questionnaire and check off the CPE request box located at the top of the questionnaire. Before I turn it over to Tony, I'd like to provide a brief overview of AFS and our SOFTRAX products and how they benefit companies with complex revenue processes. As many of you know, SOFTRAX products were initially developed to serve the complex needs of the software companies, and we're the clear leader in that market. Today, hundreds of companies across many different industries trust SOFTRAX products to manage their billing and revenue processes to ensure they comply with appropriate revenue recognition and Sarbanes-Oxley requirements. We deliver enterprise billing and revenue management solutions that optimize order-to-cash and order-to-revenue processes from complex contracts, billing arrangements, and contract renewals through revenue recognition, reporting, and forecasting. And our mission is to help customers consistently grow their revenue and reduce their costs while maintaining compliant with ever-changing regulatory and accounting guidelines, such as those Tony will be reviewing with us today. If you are manually managing your revenue recognition processes and spreadsheets or are struggling with how to comply with EITF 081, we'd be happy to see how we could help. One of the key challenges companies face today is consistently complying with complex and changing revenue accounting guidelines. Initially, this was principally limited to software companies with the introduction of SOP 97.2 in 1998. But since that time, there have been a number of new revenue guidelines that companies across many different industries have struggled to comply with, the latest example being 081. Knowing that additional changes will be coming with EITF 089 and IFRS on the horizon, companies are looking for a more reliable way to ensure compliance with the appropriate revenue accounting guidance. What many companies are coming to recognize is that in order to ensure they remain compliant as accounting standards change, and as well as when they introduce new products and billing models, they need to systematically manage order to revenue as a separate and distinct process from order to cash. Over the past 10 years, we've had the opportunity to work with hundreds of companies to optimize their order to revenue processes, and in particular, complex revenue allocation and recognition management processes for SOP 97.2 and EITF 021, for example. Based on this experience, there are 3 key areas we recommend you focus on to ensure an effective and compliant order-to-revenue process that adheres to 081 where appropriate. The first consideration is adopting best practices around this compliance is to establish fair value, or actually in the case of 081, selling price for your products in the various markets in which they are sold. In doing this, you want to make sure that the way you establish and manage your selling price is consistent with the way you go to market. You'll want to consider the external parameters that affect the way you package and sell your products, such as geographic region, channel, or industry. To do this most effectively, you'll need a centralized repository of revenue data containing all of your selling price information for the appropriate periods with the ability to analyze and sort it by the relevant parameters that affect your pricing. The second best practice consideration is revenue allocation. In the case of 081, you'll need to identify all separate units of accounting for each arrangement, even if they're not separately billed for. You'll then need to allocate revenue using your established selling prices across these units. To do this most effectively, you'll need a repository of 081 selling prices, as we just discussed, but you'll also need a process to consistently allocate the revenue across these units in the arrangement using your 081 selling prices. And third, for each unit of accounting in the arrangement, you need to manage the revenue schedule and ensure all revenue recognition conditions have been met before releasing revenue for each unit. You'll want to systematically track revenue allocations for each arrangement as well as release conditions to support your audit and compliance requirements. And of course, you want to manage your order to revenue process without restricting your ability to change the way you package, price, and deliver your products and services to the market. From a governance, risk, and compliance standpoint, you'll want to ensure that all data relevant to your 081 order to revenue process is stored in a controlled, auditable system, including billing information, revenue allocations, and revenue recognition conditions. And you want to ensure that you have the appropriate level of reporting and documentation to maintain your established selling prices, as well as support your financial audit and compliance requirements. It's now my pleasure to introduce Mr. Tony Sondhi. We've had the pleasure of working with Tony for many years now. He's the co-author of the 2006 through 2009 editions of the Revenue Recognition Guide and the Analysis and Use of Financial Statements. Tony is a member of the Emerging Issues Task Force, the Financial Accounting Standards Board, its Agenda Committee, and its working group on EITF 081. He'll talk at the end about the many valuable programs he runs across the country for people who need to spend more time on this. We clearly have the right person for this topic, and we're delighted to have you back, Tony. The floor is yours.
Thanks, Jay. Hello, everyone. Let's get started with our work for the day. Okay. And as Jay has pointed out, we're going to talk about 081 and 093. These accounting standards have a rather substantive impact on financial reporting, but they are fairly complex and a rather significant change from current practice. At the same time, they do have a rather singular impact, which has been welcomed by a lot of companies and people who are engaged in reporting. And what I'd like to do is to give you a sense of what that effect is and how that works, and what are some of the major issues that you need to watch out for while you're preparing and making a decision with respect to whether you should adopt. So let me begin by introducing the topic, discussing some of the issues involved, and then I'll discuss some of the major concerns that you ought to be aware of in making your decision to adopt, whether you ought to early adopt, because that is still possible. So let's take a look at what we're doing in these two standards. Let me begin by discussing 081. And the most important thing that I want you to keep in mind with respect to 081 is that the fundamental, probably the most critical amendment concerns revenue allocation. You'll recall a couple of minutes ago, Jay was talking about how critical revenue allocation is, his second step. So if you keep that in mind, this is what has happened here. The concept of a selling price has replaced fair value and revenue allocation guidance. In other words, until 081 came along, revenue allocation used fair value. Now, of course, in software revenue recognition, the revenue allocation based on fair value is not quite the same as fair value that we have on the balance sheet. So I want you to keep this in mind. We have one set of principles that we're using for software, another set of principles that we're using for the balance sheet, but for the rest of revenue recognition and the income statement, we're switching over to selling price. The other thing that I believe is very critical to keep in mind with respect to selling price is that the selling price concept is based on entity-specific assumptions rather than the assumptions of a marketplace participant, which clearly would be the definition that we are using on the balance sheet. Those of you who attended my webcast in the past know that I am a proponent of fair value the way it is used on the balance sheet, to a large extent, but not as much as one would like. Be that as it may, please keep in mind that we've switched over to the selling price. Now, this switch, this amendment from revenue allocation based on fair value to revenue allocations based on selling price is also sort of a precursor. It presages, if you wish, this coming change. Because if you take a careful look at the FASB and the IASB revenue recognition project, where they're attempting to develop a comprehensive revenue recognition model, you will find that that's where they're also talking about using the selling price. So it's a very important change, and it tells you a lot about, potentially at least, where we're all going. Having said that, let me focus now on some of the other principal changes. The next one that I want to mention is that we will now use, hence once you adopt 081, you will be using the allocation method, which is the relative selling price approach. In other words, we're no longer using the residual method. Now, please don't get me wrong. If you are under 97.2, in other words, your transactions are in software and software-related deliverables, you remain subject to 97.2. I will talk a little bit later on about the carve-out that we have in 093. But fundamentally, those of you who are in 97.2, the residual method is alive and well for you. But if you're no longer subject to 97-2, in other words, you're part of that 093 carve-out, then you will no longer use the residual method. Because other allocations that are subject to EITF 081 must be based on the relative selling price method. From the many seminars that I've given in the last 2 years on EITF 081 and 093, I've detected a slight twinge of remorse, it seems. There are people who really were not ready to give up the residual method. But as I said, if you're subject to 081, you no longer have the residual method. It's only in 97.2. Now, for the other two principal amendments, the next one that I want to talk about is that in order to apply 081, as I said, allocations are based on the relative selling price method. That relative selling price method requires that you establish selling price for each deliverable, again, as you'll recall Jay mentioned earlier. Now, that selling price for each deliverable has to be determined using VSOE of selling price. VSOE meaning vendor-specific objective evidence of the selling price. If it exists, where you don't have VSOE of selling price, you will use third-party evidence of selling price. If you don't have either VSOE of selling price or the third-party evidence, you don't have either of those, then your next possibility is to use your best estimate of the selling price. Now, please notice that you have to have one of these three, right? So it's VSOE of selling price, next in line, third-party evidence, and failing those first two, the best estimate of the selling price. Now, please keep that hierarchy that I've just mentioned in mind, because I'm going to raise a question that you have to consider, and it's going to be one of the most important decisions that you'll make, but it's not a one-time decision. You'll have to continually think about this. Very critical element. Now, please keep in mind that, as I said, the fundamental shift here is from VSOE of fair value, or as it was in EITF 0021, the objective and reliable evidence of fair value. We've switched from fair value to the selling price. And I just pointed out the hierarchy. VSOE, followed by third-party evidence, followed by a best estimate. Now, although EITF 081 amends 0021, and it now requires that you use selling price, and maybe failing VSOE and third-party evidence, you'll end up using the best estimate. The standard, however, the amendment, however, does not provide any specific methods that a seller must use to develop its best estimate. Now, I am in accordance with that. I agreed with that aspect of it when we worked on this standard on the EITF, because I don't believe that it is possible for us, nor is it something that we ought to be doing, specifying exactly how different industries need to go about this. And it's not just different industries, different products within industries. The development of an estimated selling price for intellectual property deliverables is certainly significantly different from the development of an estimated selling price for manufacturing deliverables or retail deliverables, for example. And it certainly gets a lot more complex when you think about some of the high technology deliverables that we have in biotech, in some of the software devices, or the kinds of deliverables that are subject to 093. So fundamental principle that we have with respect to the development of an estimated selling price is noted over here. So as I've pointed out, the principle is the best estimate of the selling price must be consistent with the objective of determining the price to sell that deliverable on a standalone basis. Now, you'll notice my comment below that is, please observe the similarity to the VSOE of fair value concept that we had, that we certainly today have in SOP 97.2 and SOP 98-9. But not only that, notice its similarity to the concept of the objective and reliable evidence of fair value that we had in 0021. So in that sense, it hasn't changed, and yet it's a selling price and not any form of fair value. And that, I think, is a critical element that you need to be very, very clear about. So we're supposed to, in other words, go about developing our best estimates in the same way, let me be more precise, in developing our best estimates of selling price in the same fashion as we did VSOE of fair value. However, keep in mind the first point I made. That is, we're now allocating in terms of selling price rather than fair value. In other words, we're emphasizing entity-specific assumptions. Therefore, what the standard is telling us is that we need to come up with an entity-specific estimate of what we would sell that particular deliverable at all by itself. That's the standalone value definition. Okay. Now let's go back and take a look at 0021, and let's talk about briefly why we are here in 081. I know there are so many people who love 081 that they don't necessarily want to spend too much time talking about what 0021 was or anything, but it helps to understand it, so you'll have to indulge me in this. Recall that the separation and allocation guidance in 0021 was based on the ability, or looked to the ability, to meet three criteria. The first criterion applied only to delivered items. Those delivered items had to have value to the customer on a standalone basis. The other two criteria that you had to satisfy dealt with the undelivered elements at the inception of the contract and also subsequently after each item was delivered. So the second point is that you need objective and reliable evidence of the fair value of the undelivered items. Now, the reason I have this in red is because that is what constituents told us was the main reason that they were unable to recognize revenue at inception, or at least sufficient, shall I say, revenue at inception. And it led to a rather significant increase in the amount of deferred revenue, which has its own problems, and you have to start thinking about a whole host of other issues. But that was the main stumbling block, the second criterion. The third criterion is straightforward and normally does not create problems. Third criterion says that if the arrangement includes a general right of return with respect to the delivered items, then performance with respect to the remaining or the undelivered items, that performance has to have two characteristics. It needs to be probable, and second, it should be substantially in control of the vendor. But as I said, please keep in mind, the third criterion did not get in the way. It was the second criterion that held up a lot of people, and as a consequence, many companies complained that the resulting revenue recognized was uneconomic. In other words, it did not reflect the economics of the transaction with respect to either the amount or the timing. So that was the main concern that people expressed. So after a fairly lengthy deliberation, several meetings, in fact, the task force agreed that separation and allocation in multiple element deliverables would henceforth require that companies satisfy two criteria only. We retain the first one, that is, the delivered item should have value to the customer on a standalone basis, and we retain the third. So we eliminated the one that was the major stumbling block. Now, as a result, you will see an acceleration in the amount and timing of revenue recognition for companies that are adopting 081 relative to what they were reporting, again, in terms of amount and timing with respect to transactions subject to 0021. Now, there are some comments that I'd like to make here, so let's stop for a few moments. And the first thing I'd like to point out is that clearly eliminating that second criterion, that is no longer required objective and reliable evidence of fair value in order to separate and allocate in multiple element transactions, what the EITF has done is, as I said, eliminated that second criterion. Therefore, I think there will be more scrutiny from the auditors and the enforcement unit of the SEC, most likely. There'll be more scrutiny on whether the delivered elements have standalone value. Now, the problem, therefore, is that if standalone value is critical and it only applies to delivered items, then obviously the order of delivery becomes much more important. So this is a very important thing to keep in mind when you're drafting your contracts and talking about the order of the delivery of the different elements in the contract. Now, clearly, the order of the delivery would also be dictated by economic needs or terms and so on, and therefore you have to keep that in mind because you should not let accounting get in the way of the economics of the transaction, of course. Now, so that was 081, the fundamental principles about 081. The other concern that the EITF dealt with at around the same time that we were working on 081 had to do with a large number, and not just a large number, but I should be more precise and say a growing number of transactions where companies are delivering the essential functionality of their products and services, not just in terms of software or hardware, but in combinations. and we needed to find a way. We had to determine fundamentally whether 97-2 should apply to those kinds of transactions. It's very important to keep that in mind because, remember, 97-2 says that it does not apply to products and services where software is incidental. However, the concept of incidental software are discussed in a footnote to 97-2. So there was need to think a little bit about that. So here are some of the principles. I'm not going to give you all of them because there are other things that we need to talk about today. But let's begin by this. The point we begin with, the fundamental principle is that if sales of a tangible product without the software component are infrequent, then we said that there's a rebuttable presumption that the software element is essential to the functionality of the tangible product. Because fundamentally we're looking for products and services where a tangible product works with the software. The two work together to provide the essential functionality of that particular product or solution, as people like to very often say. Now, it is also, we said, that if you sell products that provide similar functionality, such as different models, then whether the different models are subject to 093 is a function of what the significant difference between those models is. Right? So if the only difference is that one includes software and the other product does not, then they would be considered the same product for purposes of evaluating the previous principle. The fact that a vendor sells software on a standalone basis and at the same time also sells a tangible product which contains that software, the fact that the software is sold separately does not lead to the presumption that software is not essential to the functionality. In other words, a separate sale of software is not going to affect the fact that transactions where software and the tangible product are sold together, the latter, those are subject to 093. Now, at the same time, we didn't say that software elements had to be embedded within the tangible product. In other words, a software element could work with a tangible product, and then the two together would provide the essential functionality. The next point that I want to be very, very careful about is that the non-software element of the tangible product needs to substantively contribute to the tangible product's essential functionality. Now, clearly, there are certain examples that we can see where this is fairly straightforward. For example, if the tangible product or the non-software element, rather, say the hardware component, if that hardware component is merely a delivery mechanism, then of course you're not going to be able to carve out of 97.2 and fall into 093. The point is that the non-software component and the software component, the two have to work together to provide the essential functionality. So that's very important. One of the sort of critical issues to think about here is to what extent does the hardware or the non-software component have to provide or contribute to the workings of that particular product? To what extent does that have to be incremental, over and above what you could do with the hardware product alone? And so that's the fundamental, and that's where a lot of people are having issues. But please keep that. The point is that the non-software component has to contribute substantively. It's very now. Let's take a look at some other issues. So those were the fundamental principles, the concepts of those two standards, 081, 093. Now, as I said, you have to develop estimates of selling price. Some of the concerns are certainly straightforward. The way I think of selling prices, I think what you want to be very, very careful about is this. The fundamental components of an estimate of selling price are three. There are costs, profit margin, and then there are discount policies. Now, some people think that the discount is a component of the profit margin, and that's perfectly fine. I prefer to think of them separately simply because it allows me to consider the variables with a greater. It's sort of the concept that I've always followed in standard setting. Gross is preferred to net most of the time. Because whenever you net things, you're losing information. You don't want to do that. So from that perspective, keeping that in mind, rather, I'll say let's talk about cost, the profit margins, and now, with respect to the cost, direct and incremental manufacturing costs probably give us the least amount of problems. Very straightforward. For hardware, for retail products and services, there's no question that we can easily develop those. But then if you go to the other end of the spectrum, you have to think about intellectual property transactions. In intellectual property transactions, correlation, or just simply the relationship between cost and value, gets increasingly indistinct. Software is another product where it's very difficult. I think software devices are another word to sort of effectively determine what the relationship is between costs and a selling price. So those are difficult. Identifiable selling, distribution, fulfillment costs are easier to use and understand. But what becomes difficult is R&D costs, other indirect costs, because R&D is very, very difficult to attach R&D expenditure to a finished product. It's very difficult to attach indirect costs to a unit of product or an item that is sold. However, at least with respect to indirect costs, we are comfortable. We're used to the allocation process. Unfortunately, all allocation methods are arbitrary. They just have varying degrees to which you can sort of defend how good they are. Most of the time, they're arbitrary. Now, having said that, give you an idea of how difficult and what some of the issues are with respect to cost, please keep in mind that the next thing you'd like to do is to figure out profit margin. But there, what you're effectively attempting to do is you must understand what capital costs have been incurred in developing this product and making it available for sale. The amount of money that you have to spend on distribution channels, for example, is certainly a valid component of the marketing strategy that you have to. You begin by thinking about what capital was used to develop this product, make it available for sale. And from there, you need to figure out how much of it earned. But of course, that's going to be affected by market and competition considerations. The amount of competition you have for a particular product, that is going to dictate how much of that profit you recover, or how much of the capital cost you're able to recover, I should say. Then, in effect, you have to overlay, right? So, in a sense, think of this as building blocks. You begin with an understanding of cost. Then you layer onto that how much of a return you need to earn. On top of that, you think about competition. Where is competition going to make it difficult for you to get the return? Where is it going to be straightforward and possible to earn a return earlier than elsewhere? Then the other thing is you've got to think about discounting strategies. What kinds of discounts would you like to offer people to introduce them to your product, to the quality of your product, let's say? So these are all the different factors that you need to consider in coming up with an estimated selling price. Each of these requires a rather significant amount of data collection, documentation, and internal controls, and continuing monitoring. One of the advantages of using VSOE of fair value was that you looked to prices that you were able to achieve in your marketplace. Now, of course, the problem with VSOE of fair value, that among the problems, one of them was that you were constrained in your discounting policy to some extent. You had to constrain your sales force to some extent. Here, when you're setting estimated selling prices, it may appear as if you have more leeway, but it is going to demand a cost in return, and that is going to be in terms of documentation. With respect to costs, you have to be careful with respect to not just the data collection, but there's also a rather significant issue with respect to how you allocate it. What processes are you using to attach and allocate? Profit margins. Where do you get the data? How good has your company been at collecting information which allows you to determine what the capital costs were? What did it cost you to get ready to sell this particular product? Those are some of the issues that you have to be concerned about. You also have to think proactively about what kinds of discounting policies and at what level will you permit your staff to effectively employ those discounts. But things have become a little bit more difficult with respect to that. At least that's the way I look at it. The documentation, the internal requirements are quite significant in your application of 081 and 093. Now, one cost, in a sense, of getting this acceleration in the amount of timing of revenue recognition, one of your costs is disclosures. And this is where the EITF, I think, at least I faced a rather fundamental problem. You see, because what I was looking at, the fact that here it is, we were going to allow companies to use, because of problems, we're going to permit companies to use a selling price to reflect how much they've earned. However, we're not placing any reasonable requirements on that estimate of selling price. So what kinds of disclosure do we need from companies in order to understand what has happened? So the disclosure requirements here focus on the significant judgments that are made in applying 081. And then it focuses on changes in those judgments over time. Now, you also need to be very clear about something else with respect to the emphasis here to a large extent is on qualitative disclosures, which have to be supplemented with quantitative when the adoption has a material effect on the financial statements. Now, the interesting point is, I don't know how you can quantify whether there's a material effect and then report only qualitatively. In other words, in order to get an appropriate qualitative assessment, you need to begin with a quantitative assessment of what the effects are. So some of the issues to be concerned with. How good are your internal documentation processes? How much information do you have about your products and services? What about your internal controls? How good are those? How much conversation occurs between, in other words, how much information is exchanged between those who set prices in your organization and those who develop the financial statements, internal and external? The point is that these may even be two separate databases, two separate ways of looking at, two distinct different ways of looking at things. But now your pricing and your reporting people have to talk to you. Those are some of the critical issues that you have to think of. Where are you in your business model? Have you just introduced the product? Is it a season? Where is it, in other words, in its life cycle? The earlier the product is in its life cycle, the more difficult it is to come up with a selling price. And again, if you're a price taker, it's different. If you're competitively advantaged, that creates another kind of a difference. The organizational structure. How much control do you have over your contracting process? How much control do you have over the sales process? These are issues that will affect your ability to develop reasonable estimates of the selling price. These are the things that will affect your ability to determine whether you're ready to adopt the standard. So some of the key areas that you have to think about: the development of estimated selling price and its relationship to sales or discounting discipline, the standalone value of the product that you've delivered, the item that you deliver first or at inception, different disclosures that you will require, documentation. Then I think there's a financial reporting risk, because if you're not comfortable with your estimate of selling prices, it's going to be more difficult to get comfortable with what you're telling companies, what you're telling your shareholders, your stakeholders that you've earned. The other thing that I believe, another where you should remember, I said earlier, there's a hierarchy of selling prices. You begin with the SOE of selling price. Your next choice level is the third-party evidence, and then estimate. Think about a very simple example where you have 3 deliverable bundled arrangement. And for the first one, you have the SOE of selling price. The second, you have third-party evidence. And for the third, you have nothing today. This is prior to adopting 081. Then under certain circumstances, you can only get ratable revenue recognition. You adopt 081, you'll develop an estimated selling price for the third item. And then you'll be able to take revenue as those products, the first 2, are delivered, and so on, under most circumstances. The question that I want you to think about is, are you going to continue, do you have to continue to develop VSOE and sustain the VSOE of selling price and the third-party evidence, where you can always use an estimated selling price? I think that's going to be a function of enforcement. The standard says that you should use VSOE of selling price if it exists. Failing that, you should go to third-party evidence. And only then, in the absence of third-party evidence, would you go to your estimated selling price. Okay? Then the issue is, should you adopt early? I think that one of the most critical things to do is to take a look at what the effects will be, go through your financials, look at how many transactions are going to be affected. How will that affect your documentation? Do you have the processes in place to do that? These are some of the things. And then next thing I would do is write up your disclosures. Start thinking about what your disclosures will look like. That'll give you a sense of how much information you need in order to determine whether you should adopt early or not. Okay? Now that's basically what I wanted to say about 081 and 093. I know it's not sufficient, which is one of the reasons why I'm conducting these 1- and 2-day seminars that I've listed over here, because it does take a lot of time to think through, discuss all these different topics. So here on your screen you have displayed the coming schedule, seminars and so on. There's actually one in Raleigh on the 11th and 12th of March that you may want to consider. And I see that I think we've left that one out. But do take a look at that. And then there are other seminars as well. And I'd like you in particular to think about the software RevRec classes. There's also a basic revenue recognition, sort of a introduction to people who are just beginning in revenue recognition. You'll notice that I've placed that on the 28th of April, the day preceding the 2-day software class. So if you want to try that, that should be something that there's a significant amount of work that we're going to do in those 3 days. Please also take a look at the securitization seminars, the FASB, ISB, EITF updates. I invite you to take a look, and I look forward to seeing you there. And I'm ready for the questions, Jay.
Excellent, Tony. We've got a lot of questions here, so we'll go through them as quickly as I can, try and consolidate some to get to them. First question is, am I correct in stating that a consequence of 081 is that SAB 104's interpretive guidance pertaining to perfunctory deliverables will no longer be applicable? So instead of perfunctory deliverables would be required to be separated using estimated selling prices.
That's correct. I believe that the inconsequential and perfunctory guidance of 104 is no longer operative. I believe that there are a lot of people who think it still remains, but I would say no.
And then there was just a follow-up on that, which is even if the deliverable is considered inconsequential.
Yeah, it doesn't really matter.
Okay.
You have to, and in fact, in one sense, Jay, I think that we carried that forward from 0021, that you have to allocate regardless. It's just that because 081 requires that you have to come up with an estimated selling price for all the deliverables, it makes it even sort of emphatically so.
Okay. Then next question is, what if you have VSOE for one deliverable and third-party evidence for another? Can you use different evidence in the hierarchy for deliverables within the same arrangement?
Sure. That the whole idea is for each individual deliverable, you've got this hierarchy. So within that hierarchy, so long as you have one of those three, and across a bundled arrangement, you may be using different levels of evidence. That's
okay. If the company is the only entity that can provide installation services due to patent restrictions for a product, does that preclude the equipment from being recognized as a standalone basis under 081?
Well, the fundamental question there is whether benefits, risks, and benefits have been transferred to the customer upon delivery of that equipment absent the installation. That's the fundamental point that you have to resolve. And that's what will allow you to determine whether you can recognize revenue upon delivery. So the operative issue is, I think, whether the benefits have been transferred.
Okay. What controls do you recommend for establishing best estimate of selling price for items that are not regularly sold, such as intellectual property?
The fundamental thing is that you have to think what you would sell that intellectual property for on a standalone basis. So when you start with that, it's the components of that estimate that you have to document. What's the basis, for example, of saying this is what I'm going to charge for it when I sell it separately? So, for example, you begin with how much did you spend in developing that intellectual property? Now, this is where you have to recourse to thinking about FAS 86, which talks about what the R&D costs were in software, for example. Use the concepts in there. Take a look at SOP 98-1 on internal use software. Think about what that says with respect to the different kinds of costs. Then think about how you're allocating any indirect costs. Then you have to overlay that, as I said earlier, with what your profit margins ought to be. One possibility is that you may have to think about what if, for example, there's competition. Some others are selling similar products or services. There are some very interesting companies that sell intellectual property today. In fact, there are some very large publicly traded companies that are effectively in the business selling intellectual property. Those are the companies where I would go take a look at what they're saying in their disclosures. And that, by the way, is one of the things that I'm doing now is I'm putting together a database of adopters and looking at the different kinds of factors that different industries ought to be using. But that's what you need to do.
Excellent. Thanks. Here's an interesting one for you, Tony. In estimating selling prices, is it allowed to have a negative profit margin because we want to eliminate competition and gain market share?
Well, whether you call that negative or negative profit margins, or you're discounting such that in order because that's part of your go-to-market strategy, those are certainly acceptable ways of determining what your pricing should be. The point that you want to be careful about is, how much of a leeway will you give your sales staff and so on? How are you going to set that? How are you going to control the amount of that discount? And when that discount starts including, becomes a negative profit, so you're losing money, in other words, to some extent. And then you've got to start you also should think at that point about under what circumstances are you going to stop giving that much of a discount, or are you going to stop losing that amount? So effectively, business strategies, all kinds of business strategies, I think, are acceptable because that's what you're trying to do. You're trying to sell in the marketplace. But the allocation has to be thought through very carefully. And at least internally, I think the disclosures ought to be very clear as well, but internally you need to understand why you're doing that, how long you're going to do that, and what the basis is for doing that.
Okay. Next question is, we have a new product that contains a PCS deliverable, which the company has not yet had the opportunity to provide a standalone basis until renewal. Can published renewal rates be considered as evidence of estimated selling price?
Well, the first thing is that this PCS that the question asks about, the first question is whether that would be subject to 081 at all. The type of PCS that would be subject to 081 would be the one that relates to an 093 deliverable at the initial transaction. There, the published renewal prices, and in this particular instance, because it's new, if I remember the question correctly, or I understood it correctly, rather, then at least it's part of your database of information that you use to come up with an estimated selling price. Then you have to think about how much weight to put on it. If this question is about PCS that would be under 97.2, then selling prices can't be used because 97-2 has not been changed. So for software-related deliverables, PCS, you still need VSOE of fair value or the stated renewal rate. But then there are a whole bunch of technical practice aids that help you figure out whether the stated renewal rate is substantive with respect to term and rate and so on. But you have to be very careful whether this is 081 or not.
Okay, the next question is regarding the current changes with 081. It is meant to help companies that were deferring revenue because they could not establish fair value. What about companies that could establish fair value for undelivered items but were just fine with the residual method? Are they going to have to establish estimated selling price for all delivered items?
Yes, those transactions, the bundled arrangements that are now subject to 081, and primarily that would be outside of 97.2, for those you can no longer use the residual method, which means, yes, you have to develop estimated selling prices. I know that's going to make me really popular.
Well, at least with one questioner, it's not going to make you popular. Under 081, when estimated selling price is used, is there any guidance on thresholds that need to be employed, similar to 97.2, when 80% of standalone sales fall within a range? Is there any similar guidance for 081?
Well, strictly speaking, VSOE of fair value, that bell curve approach that people use, that was a practical response to the standard. The standard simply says price at which you would sell it normally on a standalone basis. So in that sense, since 081 and 093 continue the same guidance, you'll recall one of my slides where I showed that the standard says it should be the price at which you expect to sell it on a standalone basis. So in that sense, nothing has changed. So at least my assumption is, my inference from that is that nothing has changed with respect to the bell curve either. That is, the type of information you need still requires that your selling price be within that range, because that should be the price at which you sell it. Now, at the same time, I would like to add that it took a little bit of time for the marketplace to develop that bell curve approach, the 80% plus minus 15% and all of that. We'll have to see what the market does with respect to estimated selling prices. There are certain interpretations where you might say that it's not quite the same thing and therefore I don't have to do that. I'm not sure that that's the case. I think we're going to have to wait to see how the accounting firms, for example, effectively enforce and apply 081 and 093. So to some extent, I certainly don't think you can come up with a laxer standard than what we had before, because the principle is similar.
Okay, and kind of on a similar vein, how is selling price different than the price you have sold your product for over time, which was used to determine VSOE historically under 0021?
Well, in that sense, it isn't different. I mean, if you had VSOE or objective and reliable evidence under 0021, that price is a perfectly acceptable price and estimated selling price. No question about it. Because the idea is, remember, principle is your estimated selling price should be the price at which you intend to sell it on a standalone basis. And that's the definition you used in 0021, in which case it would just continue using the same number.
Okay, and then this is an 093 question. In a situation where both a hardware component and software component exist, how do you take into consideration where neither can exist without the other, i.e. the hardware could not be of value without the software, but conversely the software would not be of value without the hardware?
Well, I mean, that sounds like one way to say that the two work together to provide the essential functionality of that particular deliverable in the marketplace. And if that's what is intended, then it's sort of an ideal 093 deliverable. Now, the interesting question, as I pointed out during my remarks, was that that substantive contribution argument is very important. Because one of the things that people are starting to find is that their software actually may be used on different tangible products, different hardware. Some of them are finding that they were selling their software on hardware that actually has a whole bunch of other uses. Or some of them are saying, well, we sell our software on hardware that we purchase from a third party. And people would, the third party was selling that hardware for other reasons. They had never thought of, or maybe it was not their intention, to sell it for this particular piece of software. But the question itself seems a rather narrow definition of the 093. There are some other, much more complicated issues.
Okay, and this is kind of similar to if someone has to follow the 081 allocations. I'm sorry, I lost my place on it. If the deliverable has no standalone value and can't be recognized on a standalone basis, do you still have to allocate an estimated selling price over the customer relationship period? So I think they're asking us, can they still do a spread for something where they don't have standalone value?
Well, if you don't have standalone value, then you don't meet the criteria for separating. Because remember, as I pointed out, in 081 we have two criteria that have to be satisfied. The first of which is that the delivered items must have standalone value. Now, if you can't separate, then you got to go to the next element, combine the two, and see if you can separate those two. So the allocation is a function of where and what you can separate. So you always allocate to the units of accounting that you come up with, but if you can separate, let's say you start with two, you have a bundle arrangement that has two deliverables. If you can separate them, then you have to allocate to each of those two. A portion goes to each of those two deliverables. But if you can't separate those two deliverables, then there is no allocation in that two deliverable multiple arrangement because you couldn't separate, therefore they're single deliverable.
Okay, well, we're running up against the clock here in terms of our hour for the webinar here, Tony. Thank you very much for sharing your insights with us today. And I'd like to thank our audience for their participation and all of their questions. On the screen now, you'll see the RevenueRecognition.com website listed. It enables you and your peers on many different topics to continue the dialogue, and in particular on today's topic, if you'd like. Please watch your email, RevenueRecognition.com and AFSFinancials.com for future executive webcasts such as these.